Hi, my name is Alex Carlucci with GustanShow.com. I'm going to talk to you about pricing rates on loans these days and how complicated it's become, because I guess the only easiest way to say is the coupons at the higher rates aren't paying what they used to pay back in the good old days. So just recently, in the last 2 years, we've noticed it getting smaller and smaller and smaller. And what that means for you is that, let's just say the going rate's 4%. Let's say you don't have any closing cost money and the sellers aren't going to credit you anything. In the old days, I would have raised your rate to 5% from 4 and given you 5%, and I would have given you like 3 percentage points times the loan amount credit. So if your loan amount was $200,000, I could give you a $6,000 lender credit by giving you that higher rate. Nowadays, that 5% is only crediting like a half a point. So if the going rate's 4 and I give you 5, I'm going to give you a half a point credit, so $1,000 versus $6,000. And the reason is that banks, for some reason, don't want to pay. I'm hearing the reason is because a lot of people are refinancing those higher rate loans pretty quickly, so the banks aren't offering those large credits at those higher rates. Now, that's one scenario where it affects you, but what it's really affecting us on the discount, these are called discount points that you're paying for. Well, this is what I'm going to talk about, discount points. So this is what really affects you. So that par rate is 4%. Let's say it's owner occupied, you got 780 credit score. Now, let's say you're doing investment property, cash out. Now you get these adjustments. Now, these adjustments are little charges that we have to hit to that back side of those rates that you don't understand. Like I told you, the 5% used to give it 3-point credit. Well, to do cash out on investment would cost 3 points on our little pricing sheet. That's what the charge is. So what we would do in the old days is look at 4% as the rate and look for the next rate that was covering those 3 points. We'd say, okay, sir, it's going to cost you nothing, but we're going to have to sell you a 5% interest rate. Well, now with it only giving you a half a point credit at 5%, it's going to cost you 2.5, because the 3-point charge is still there for investment cash out, but the 5% rate's not enough to credit you the 3 points. So now the 3 points absorb that half a point, and now it's a 2.5 point discount to you. So that's how it's really affecting people. So people with low credit scores, with certain types of other adjustments, maybe it's a condominium, maybe if it's investment, maybe it's cash out, you're subordinating a loan. These all come with little adjustments that need to be absorbed with the higher rates, when the higher rates aren't actually giving enough credits to absorb these things. So then we have to give you a discount point, we have to charge you. So that's happening a lot more of my loans lately, is these discount points. But so be prepared that discount points may be in your future if you have a very unique situation, low credit scores, unique type of properties, multi-units, investment, cash out. That's discount points. That's the best way I can explain it to the average person who doesn't know the business. But if you have any questions, you can give me a call anytime at 630-915-7550 or go to GustanShow.com. Thank you.